I am Chartered Accountant Dr. Dilip Sadbhai and bringing it to your notice certain important changes which have been made in the current year assessment year 22-23 for filling up ITR 1, which is known as Sahaj Income Tax Return. Sahaj Income Tax Return, that is ITR 1, is very popular amongst the salaried people, the pensioners, and those persons who are getting income from other sources. So you will ask me a question that what are the basic minimum norms which are required to be satisfied in order to get this return filled up by any taxpayer. The first important point which we need to note here would be that those persons who are having gross total income up to rupees 50 lakhs, these persons only will be eligible to file this income tax return. Second important point that we need to note here would be that if you are having an agricultural income in excess of rupees 5,000, then you are not eligible, which means that if your agricultural income is less than rupees 5,000, then you will be eligible to file income tax return. The third important point that one needs to note that in case you are having multiple houses, more than one house, then in that case you will not be eligible to file this income tax return. And the last point that we need to understand here would be that you must be resident in India. Then and then only you will be eligible to fill up this return and file and upload the return to the income tax portal. Now there are two issues or three issues which are required to be identified, that who will be ineligible to file this ITR 1. Now those persons who are having more than one houses are technically not eligible to file this particular return. Second important point, that those persons who are drawing salary or pension or other gross total income to the extent of more than 50 lakhs rupees are also ineligible to file this income tax return. The third point is that if you are claiming loss from house property and that is required to be carried forward by you in the next year, then in that case the person concerned will not be eligible to file this particular income tax return. Then those persons who are earning some prize income from horse races, etc., those also will not be in a position to claim file this income tax return. Assessees who are having short-term or long-term capital gain also would be considered ineligible to file this income tax return. So these are the basic issues which we need to understand, and in addition to that, there are certain other factors which we need to identify, that in case you are having some estate outside India and as a result of which some fixed current assets are there outside India, then those persons also will not be in a position to file this particular income tax return. In addition to that, if you are claiming some double taxation avoidance agreement relief either under section 90, 90A or 91, also will not be in a position to claim this particular benefit of ITR 1. Now you will ask me a question, why ITR 1 is so much popular nowadays in the country? It is a very simple form. It can be filed online or offline depending on the need of the assessee in itself. And this being a very simple form, anybody without the help of any tax consultant or any other professional can file this particular return. And the most important point, which is the added advantage of this particular return, is technically it is a scrutiny less income tax return. Normally income tax department does not scrutinize these particular returns in itself, and that is the reason why you get refund very fast speed, and that is the reason why it is known to be very popular amongst the assessees in the country in itself. Now in this return, some 3-4 important changes have been made in the current year. The first important change that has been made is about the classification of the pensioners, because pensioners also can file this ITR 1. Now previously there was no separate classification for state government, central government employees or pensioners, but nowadays from the current year there are now 4 boxes which have been specified, and you have to select one of them, whether you are a central government pensioner, whether you are state government pensioner, third, whether you are public sector undertaking pensioner, or you are other pensioner in itself. In other pensioners, you can cover up even the family pension earned by you itself, and that is how the first item or either of the four boxes. You have to tick it up, and that will become the change that ultimately has been passed in the current year's ITR 1. Then the second important change that has been made is about those persons who are or who were residing outside India. As a result of their services outside India, the employers have paid them some retirement benefits, and these retirement benefits they have brought inside India, and now they wish to claim certain benefits under the tax laws in itself, for which section 89 capital A has been introduced. Now, under this particular section, there are two categories of countries. The first category of the countries is very United States of America, United Kingdom, Northern Ireland, and the Canada. So, in case you have received benefits, retirement benefits in these particular countries, then you can claim benefit under category 1. A separate column is required to be filled up. In case you are having the retirement benefits other than from these four countries, again there is a provision under 89 capital A, for which you will have to specify that in a separate column, which is just underneath the above column in itself. So this is what the major second change that has been introduced in the ITR 1 in itself. The third important change that has been made is about the interest on provident fund. In case in a year's time, that is in the last year, you have paid provident fund contribution in excess of 2.5 lakhs, then the contribution which is in excess of rupees 2.5 lakh and interest earned thereon will be chargeable to tax in the current year's income tax return. So say for example, you have contributed 50,000 rupees per month towards provident fund. So in a year's time, you have contributed rupees 6 lakhs. So this 6 lakhs of rupees will be divided into two accounts. The first account will be non-taxable account, which will be 2.5 lakh. Interest earned on that will be totally exempt. And the second category will be taxable in provident fund in itself, wherein interest on that particular portion of 3.5 lakh will be chargeable to tax. This interest on 3.5 lakh in the instant case is required to be specified in the ITR 1 in this particular column. So once that is being done, the third important change will be said to be satisfied. The last one which is required to be remembered is about whether in the last year, whether you have opted for the tax regime, which is the new one that has been introduced by the government of India, or you are going or following the same path of old tax regime that you wish to continue. So you have to only say whether you are opting for new or not. If you are opting for new, you have to say yes, and if you are not opting for new, then you have to specify no in itself. There is no need in this case to file 10IE form in case you are opting for new tax regime scheme. This is all that I wanted to say in the matter in itself. Thank you so much. If you like the video in itself, please share or comment on my video, and please subscribe to my channel if you are interested. Press the bell icon for more notifications from my channel. Thank you.